Here we go. Hi, Joe. Thanks for joining the show today. Joe Sammet is is it mortgage broker or agent? I always forget.
I am a mortgage agent with Mortgage Architects.
Okay. Joe Sammet is a mortgage agent with Mortgage Architects, and he is going to be joining us today to talk about the stimulating topic of credit reports. Thanks, Joe, for joining us.
You're very welcome. Thank you. Thanks, Isabel.
So one of the reasons I decided to talk about credit reports is a couple of weeks ago, we were doing one of our first-time buyer seminars, and it was just a topic that came up. And I'm noticing it's a topic that comes up continually with people who are looking to make a big purchase, like buying a house or a condo, because they don't understand the importance of having a good credit report, what goes into it, and how they go and make sure that they have a good credit report. So, Joe, do you want to tell us a little bit more about how important the credit reports really are?
Certainly. What I will tell you, or what I would like to start with, is credit is unfortunately not one of the things that any of us have ever been taught in school, or even our school curriculums today are not at all discussing credit perhaps the way they should. And perhaps educating young people, most importantly young people, on how maintaining a good credit score, a good Beacon score, is going to help them throughout their adult years, simply because without a good credit score, it's going to be virtually impossible to get financing going forward if they're not conscious of exactly what their credit looks like. So what we find is that unfortunately by the time we get to, or by the time an individual gets to us when they're in their late 20s, early 30s, a lot of the damage has been done already, and then we need to spend a number of years with that client or with that prospect to help them repair their credit and give them some guidance as to what perhaps they should have done when they were in their late teens, early 20s. So credit is something that carries through life with you, and it's your signature. It is your credit worthiness. It's your ability to obtain credit. It's what lenders look at to decide whether or not they're going to give you that car loan, that student loan, your first mortgage. So, again, credit is a very, very important part of people's lives. And unfortunately, as I said, it's not taught young enough on how to maintain good credit and how much, in fact, credit costs you if you don't maintain it properly.
Sure. So if you're in your 20s, what are some of the things that you could be doing to make sure that you have a good credit rating?
One of the things that I encourage young people to do is to, first of all, get a credit card of any sort. So a $500 Visa, a $500 MasterCard. Get something in their name that they then can utilize on a monthly basis and pay it off the minute they use it. Now, by doing this, you're definitely not going to be the bank's best friend because they're not making any interest off of you, because as you spend the money on their credit, you're then in turn paying it back, so that way you have a zero balance, so therefore they can't accrue any interest to your bill. So, as I said, you're not the most popular of individuals amongst the banks because they're not making money off of you, but it doesn't matter. They will make money off you in the future, and they realize that that's helping you to maintain or to establish some good credit. So, get a small credit card, utilize it, use it, buy something, pay it off. Use it again, pay it off, and pay it off as soon as you spend it. Don't necessarily wait until you get the bill at the end of the month to then pay the bill. You're best off to pay the bill or pay it online the day after you spend the money. So then that way you're much more conscious of not spending the money unless you had it available to you to pay the bill off.
Got it. And what's some advice that someone in their 30s should know about their credit?
Same type of thing, but one of the biggest misconceptions is if I have a small balance on my credit card and I don't make the payment this month, that's okay. I'll just make double payment next month. It doesn't work that way. If you cannot afford to pay the credit card off in its entirety, at least try to make the minimum payments at all times, on time or before the due date always. And simply because if you don't, your credit bureau gets flagged with a delinquency on that credit card or on that loan or what have you, and that is what impacts your Beacon score most negatively if you have delinquent payments.
Got it.
So at all times, try to make at least the minimum payment until such time that you can afford to make more than just the minimum.
And actually, maybe we should step back for a second and say, so what is a credit score out of?
Credit score is out of 1,000. In Canada, we call it a Beacon score. There are two credit bureau reporting agencies in Canada. There's Equifax and then there is TransUnion. They both have their own scoring system, but essentially what happens is there are over 200 components on somebody's credit bureau. that goes into calculating the scoring system. And what it is really a scoring system that the lenders and the credit bureau agency designed many, many years ago, and they continuously tweak it and perfect it, but it's a system that was designed many years ago to almost take the guesswork out of lending, meaning that if somebody goes to a bank to get a car loan and they have a good beacon score of, let's say, 750, 800, the lender automatically looks at that person a little bit differently than they would look at somebody that has a 580 or a 590 beacon score.
Right.
Because that beacon score is so low, there's a history there. It tells you automatically that that individual has had problems paying their bills over time. Whereas if somebody has 750, 800, 850 as a beacon score, that automatically tells us, without really looking too much further, that that individual pays their bills on time and is a very good credit risk. So the 200 elements, or the plus 200 elements that are used from a credit bureau to develop that score, I believe those are trade secrets. I don't know what exactly the credit bureau agencies use or pull from a score, but one of the things that they look at is who, in fact, you've gone to for credit.
Right.
So, for example, if you go to a chartered bank to apply for a MasterCard, you're not looked at as poorly as if you went to a BB subprime lender to get a payday loan. There you're looked at a little bit differently because you're going to a less desirable source of credit, and therefore the credit bureau looks at who you've gone to for credit, and therefore they give you a lower score because of it. Another thing that they would look at is how often you've gone and looked for credit. So, for example, people don't realize that every single time they fill out a credit application, whether it be for a credit card, a mortgage, a car loan, a rental application, they are having what's called an inquiry made on their credit bureau. And those inquiries impact your beacon score. If you have too many inquiries, you get known as a credit seeker or a credit monger, basically somebody who's looking for too much credit, and that concerns the bank. Therefore, your beacon score is negatively affected with the number or a large number of credit inquiries that you have done on you.
Wow.
These are all little things. So how often do you pay? Are you late 30 days? Are you late 60 days? Are you late 90 days? Have you ever been assigned to third-party collections? Have you ever had a car repossessed? Is your mortgage up to date in good standings?
Right.
So keep in mind that for somebody that is not necessarily a first-time home buyer, but a perhaps repeat buyer, they have their mortgage rating on their credit bureau, and if a mortgage company sees that they were delinquent 2 or 3 times in their mortgage payments, they're going to then think twice about lending them another mortgage.
Now, if someone, let's say, gets a credit card bill at the first of the month and it says it's due on the, let's say, 25th of the month, does it matter when it comes to their credit report whether they pay that bill on the 5th of the month or they pay it the day before it's due?
Not necessarily, because quite often the credit card companies are not in sync with the reporting agencies, such as Equifax or TransUnion. So the credit card companies report to the credit bureau agencies on a particular date or day of the month. And that day of the month could be completely different from when that credit bureau agency or that credit card shows as though it was paid off. So quite often, if somebody, let's say, had a $1,000 limit on their credit card and a $500 balance, they could have just gone and paid that $500 balance. I could do a credit check a week from now, and I would still see that $500 still outstanding.
Right.
Because the credit bureau agency had not caught up yet with, or the credit card company had not caught up yet with the credit bureau agency. So it really, as long as you prove that it's been paid, it doesn't quite frankly matter what day of the month you pay it. It's always better to pay it sooner rather than later, because some credit card companies actually start accumulating interest from the day you spend the money.
Wow.
So they don't wait for the statement, they start charging it from the day you've spent it. So you might want to pay that sooner rather than later.
Now, does it matter how high your credit limit is from card to card?
Not necessarily, no. That is, again, another myth, but that could very well change with some of the recent steps in both the mortgage market and the credit market as a whole. There are new regulations coming down the pipe, and one of the regulations that could change, and the rumblings are that it might change, is that if you have too much unsecured credit in your name, whether you spend it or not, it could very well work against you if you have too much credit available to you. Now, that's not the case today. but it could very well be down the road. So you don't want to have too much credit available to you while still trying to buy yourself a home or, again, buy yourself a car. You want to make sure that you are living within your means and you don't have, I guess the fear is that you have all this unavailable or unsecured credit available to you. You go out and buy yourself a car and then you go and spend all that unsecured credit, and now you can't afford either the car or the unsecured credit. So again, you have to be very, very careful with not trying to get yourself too much credit.
Right, of course. Now, so in the eyes of this Beacon score, what would look better? Someone who paid cash for their car, got a loan for their car and regularly paid it off, or someone who leased their car? Which one of those three things looks better in the eyes of the credit scores?
Leasing and buying or financing look very, very similar because, again, it's going to show as a large outstanding debt with monthly installments on it. If you borrow a car loan and pay or run it for 6 months on monthly payments and then you decide to pay it off in full, it shows that you've got a good track record by paying your bills off in more than enough time. If you go out and you buy everything cash, contrary to what one would believe whereby cash is king, if you buy cash and you do not establish debt or a credit rating, no credit is worse than bad credit.
Wow.
Okay? And the reason being is the banks aren't keen on lending somebody a mortgage when they've paid everything cash because it is so much against the grain today in today's world of finance and in today's world of technology where the banks are assuming that everybody needs money to buy something or to finance something. So therefore they get a little bit skeptical of those people that are paying everything cash.
Wow.
And like I said, by paying cash, you don't establish a record or a track record for yourself. And no credit, no track record is worse in some cases than bad credit.
Wow. Now, one of the things you had mentioned earlier was with the payday loans. So using those payday loans negatively impacts your credit rating?
It could. If they do a credit check on you and you see, because keep in mind, remember I mentioned earlier about the inquiries that are done in your name?
Right.
Every time you have an inquiry done, it shows up as to who it was that did the inquiry, what their phone number is, and what date they did the inquiry.
Got it.
So if a payday loan company is doing an inquiry on you to establish an account, and let's say you go to ABC Payday Loan Company, and then next month you go to XYZ Payday Loan Company, in the eyes of a lender, you're going to a payday loan company because you can't cash your checks through traditional means.
Got it.
Therefore, they automatically start questioning why you're doing what you're doing.
Wow. And I mean, it's funny. So for our listeners, if you're wondering why does your credit history matter to you, whether you are a renter or an owner, credit history matters because even if you're a renter, most landlords want to look at your credit history to make sure that you do have good credit, to make sure that they should be renting to you and that you will continually pay their rent because you've continually been paying their bills. I mean, I've seen cases where there's people with credit scores below 650 that basically people won't rent to them because they just don't feel comfortable renting out to people who have a lower score. So I always tell people credit is important, not just when you're buying, but even when you're renting too.
Yeah, absolutely. That's absolutely the case. Your credit, and like I said, I really can't stress this enough. Your credit is something that you should be maintaining, or first of all, establishing at a very young age, and young age being anything over 18, I think you should start trying to establish credit. But maintaining it throughout your 20s and 30s and showing a track record whereby you're borrowing and paying back, because your credit is your signature. And with good credit, you'd be amazed at how many doors will open for you. With bad credit or questionable credit or questionable trends on your credit bureau as to where you've gone for credit, you have no idea how many doors could be slammed in your face.
Right, of course.
And with no reason given, because a lender does not need to give you a reason as to why they're turning you down for a certain credit facility. They can just tell you don't qualify. But meanwhile, in the background, they know where you've been, how you've paid, who you owe money to that are reporting. So again, there could be people you owe money to that aren't reporting, but those aren't going to help or hurt your credit rating because they don't show up. But they're going to be able to see everything about you in a very quick glance. And for those of us that know how to read a credit bureau, we can see everything about you for the last 3 years. We know where you've been, how often you pay, and we can see trends. So if you've missed payments because you moved and the credit card bills went to the wrong address and didn't catch up to you in enough time. With a good explanation, it can be explained away. But 9 times out of 10, it's truly the individual's fault who just chose not to pay their bills.